Welcome to Trading Nation. I'm Eric Chemi. Today we're joined by a very special guest, Robert Shiller. He's a Yale economics professor and a Nobel Prize winner in economics. Professor Shiller, thanks for joining us here on Trading Nation.
My pleasure.
So let's get right into it. The market's, pretty low vol for the whole year, but we're starting to see a little bit of a turn down. DC uncertainty. There's a lot of things going on geopolitically. What do you think about the markets from this point of view, given how much uncertainty is out there?
Yeah, well, I try to figure out the narrative behind the market, and I've been confused a little bit lately. Some things, I have survey data through Yale University School of Management. I have a valuation confidence index, which shows that people are not at all confident about market valuation. So the general opinion is they're high. And also, 1 year expectations have dropped a lot. People don't expect the moon anymore. But that doesn't mean we're in for a correction. I don't know what it means.
That's the thing I was going to ask you about. A lot of these surveys, these confidence indicators, it's funny because sometimes people take them at what they mean, and then other times people take them to mean the opposite. That when everyone's getting confident, maybe that's the top rather than the beginning of the rally. What do you think about that?
Well, in my own surveys, I know that the major turning point in the market was the year 2000, when the market lost half its value by 2002. That was a time of very low valuation confidence. So people thought the market was overpriced in 2000. I think that creates a vulnerability. Now, I don't have a lot of examples with my data. There aren't that many examples. I think that you also see a lot of conflicting evidence. Some people think it's going to do well, and some people are arguing with them. You saw that in 1929, which I've been studying. Not that we're there, but I'm studying it for what clues did they have?
And so, yeah, that's the thing, right? I mean, you saw the clues that get conflicting. You talk about 1929, and one of the things that's out there floating around in the markets is there a big bubble crash coming? Are we going to see a 29 again, or an 87, or an 00, or an 09? What are your thoughts on that?
Well, it could happen. I don't know.
Anything could happen, right?
Well, I think we're a little bit more vulnerable. But on the other hand, we could see a continuation of the Trump bull market. There's nothing, I can't point to any short-run change. I've tried. I go on Google Trends, and I look to see, are people talking about crash or 1929, or searching on the web for that? And not really. Maybe some of that. Market correction is up. Searches for market correction are up somewhat. So yeah, I think it's a time not to be overexposed to the U.S. market. It could happen, but I'm not forecasting.
What about your thoughts on ETFs? Like you mentioned, looking at Google Trends, which suggests kind of a retail audience, but it feels like a lot of retail right now, they're just buying ETFs. They're not really individually picking stocks. And some people have said that's going to bring a lot of leverage. That's going to end badly because you can't have the whole market in ETFs if they're not actually in the underlyings. What are your thoughts on that?
Yeah, I think that the problem is that if you're talking about passive indexing, that is something that is really free riding on other people's work. So people say, I'm not going to try to beat the market. The market is all-knowing. But how in the world can the market be all-knowing if nobody is trying to beat, well, not as many people are trying to beat it. So that's a concern.
Well, that's my question. That's what I have always wondered, which is if everybody just put their money in ETFs, let's say, if everyone was a passive investor, then how would you even know what the value of any company is relative to another? Like, the whole thing would fall apart. Right. So you would need at least one active investor to make some sort of benchmark, and then everyone else could follow him.
And you hope that he or she isn't schizophrenic.
Right, right.
Yeah, that's a word. I think that the strength of this country was built on people who watched individual companies. They had opinions about them. All this talk about indexes, yeah, it's a little bit diluting of our intellect. It becomes more of a game.
That's a good point, that the strength of the country built on individual companies, people who have opinions on those. Because you're right, if you went back 100 years ago and you just said to everyone, don't even try just put your money in index funds and don't worry about blue chips or small caps or value or growth, I don't know where we would be. I don't know where the last 50 or 100 years would have brought us. So it brings me to the question then, what does the next 10 years look like if this is the trend?
Well, I don't know. It's a chaotic system, and please don't blame me for not being able to forecast well. But you know, it's an interesting point. You say, what would they do 100 years ago? 100 years ago, they never talked about indexes. Zero, almost zero. I mean, it would have been very unusual. If a newspaper article were describing, in 1917, were describing a stock market movement, they would give examples of individual stocks. They wouldn't quote, the Dow was around, but they didn't quote it.
So would you say that all this indexing, the ETFs, the passive investing approach, you think that's actually been a net bad thing for the markets?
Yeah, I think it's kind of pseudoscience to think that these indexes are perfect and that all I need is some kind of computer model to study them instead of thinking about business.
So then I imagine, though, that there are economics professors, finance professors, people that you and I know who have said, that I know they've told me, when I was at MIT and as an undergrad, they said, my entire retirement is in the S&P 500, even though I run a hedge fund on the side, and I suggest that all my students do the same thing. I mean, do you do that? Do you know professors doing that?
I know that's been kind of a mantra. And I guess it justifies a professor not wasting any time trying to work on thinking up business ideas. I think some professors think up business ideas, and maybe that's a better use of their time.
And then I was going to end with, I saw a chart going back 5,000 years. It's been in a few different publications, and they're saying that we're at all-time lows on interest rates. I don't know where they got interest rate data from prehistoric and pre-biblical times, but they're saying that the interest rates now are the lowest they've ever been in the history of mankind, and that maybe it's a secular change that we just don't need as much capital because everything's on our smartphone.
Well, that is an impressively long trend you're talking about.
Yeah.
I thought secular stagnation is a trend for 30 years maybe, but not thousands of years. If you talk about a 1,000-year-long trend, I think that represents progress. Back then, 1,000 years ago or 2,000 years ago, you didn't know you'd ever get repaid. So the financial law and regulation wasn't up to standard, so you had to charge a high interest rate. That's my explanation. I think it's progress.
I like that. Yeah, it's progress as opposed to something that just slightly changed right now. Professor Shiller, thanks for joining us here on Trading Nation. Really a wonderful conversation.
My pleasure.
All right, that was Professor Robert Shiller from Yale University. I'm Eric Chemi. Thanks for joining. We'll see you next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.